This is the Business Blackbook, where billion-dollar empires are built and collapse. Before we begin, you need to understand something. In 2008, in a single calendar year, 8 million Americans lost their jobs. 6 million lost their homes. $14 trillion with a T was wiped from the global economy. And the men who caused it got bonuses. This is the Business Blackbook, where billion-dollar empires are built and collapse. Let's start with a house, not a mansion, not a penthouse, a modest 3-bedroom house in a suburb of Cleveland, Ohio. Beige walls, small yard, a mailbox at the end of a cracked driveway. The kind of house a nurse buys, or a delivery driver, or a single mother working 2 jobs and dreaming of stability. In 2003, that house cost $160,000. By 2006, the same house was valued at $240,000. Nobody asked why. That was the first mistake. But before we get to the house, we need to talk about Wall Street, because the story of 2008 does not begin in Ohio. It does not begin in a suburb or a bank branch or a real estate office. It begins in a boardroom, in a glass tower, high above the streets of Manhattan. It begins with a question that someone asked somewhere around 1994. And the answer to that question would eventually detonate the entire global financial system. The question was simple. How do we make more money when we've already made all the money? Here is something they never taught you in school. Banks do not just hold your money, they move it. They multiply it. They slice it, dice it, package it, and sell it. And in the 90s, Wall Street had gotten extraordinarily good at this game. But by the early 2000s, the game had a problem. The safest bets, the ones that paid consistent returns, were drying up. Government bonds, blue chip loans, AAA rated assets. There just wasn't enough of them to satisfy the appetite of pension funds, hedge funds, insurance companies, sovereign wealth funds from Dubai to Singapore, all hungry for yield. So Wall Street looked around for more inventory, and someone pointed down, at the bottom of the economic ladder, at the people who had never before been considered worth lending to. On the first page of the Black Book, we find a product called the subprime mortgage. Now, the word subprime sounds almost polite, clinical. It sounds like a mild downgrade. It was not. Subprime was the industry's code word for loans given to people who, by every traditional measure of credit worthiness, should not have qualified. People with bad credit history, no verified income, no assets, no down payment. In any previous era of banking, these applications would have been rejected in 10 minutes. But this was not any previous era, because the banks had discovered something extraordinary, something that changed everything. They discovered that they didn't need to hold these loans anymore. Think about that for a second. Traditionally, when a bank lends you money, it takes a risk. If you can't pay, the bank loses. So the bank is extremely careful. It checks your income, it checks your credit, it verifies your employment. It has every incentive to make sure you can actually repay the loan. But what if the bank could immediately sell your loan to someone else? What if, the moment the ink dried on your mortgage, the bank's risk transferred completely to another party? Then suddenly, the bank doesn't care if you can repay. The bank only cares if you sign. This is where we meet the second character in our story, the mortgage-backed security, or as they called it on Wall Street, the MBS. Here is how it worked. And pay attention, because this is the engine that drove everything. A bank in Ohio gives out 1,000 mortgages to 1,000 homeowners. Some of those borrowers are solid. Some are shaky. Some are, frankly, disasters waiting to happen. The bank bundles all 1,000 mortgages into a single financial product, a security, like a bond. And it sells that security to investors. Investors receive monthly payments as homeowners pay their mortgages. The bank collects fees for originating the loans and walks away clean. Now, the investors own the risk. But here is the part that should have made everyone stop and ask questions. Nobody knew what was actually inside those bundles. Let me give you an analogy. Imagine someone sells you a smoothie. They tell you it's healthy, delicious, 5 stars on every review platform. You drink it. It tastes fine. You never see the ingredients. 2 years later, you find out it was 60% rotten fruit. That is the mortgage-backed security of 2005. Now, here is where the machine gets truly dangerous. On page 2 of the Black Book, we find something called the CDO. They collateralize a debt obligation. Wall Street took these mortgage-backed securities, which were already bundles of thousands of loans, and bundled them together. Securities of securities. Debt on top of debt. Risk layered over risk. And they sold them again to different investors at different risk levels with different ratings. And who was rating them? The credit rating agencies. Moody's, Standard & Poor's, Fitch. The same agencies that were being paid by the very banks whose products they were rating. You understand what I just said? The people grading the exam were being paid by the students, and the grade was always AAA, the highest possible rating, reserved for the safest investments on earth. The kind of rating that said, this is as reliable as lending money to the United States government. They were giving that rating to bundles of loans taken out by people who had stated their income as $200,000 a year and were actually earning $38,000. This was not incompetence. This was incentive. By 2005, something almost impossible was happening in the American housing market. Prices were rising everywhere. Every city, every suburb, every zip code, and because prices were rising, something peculiar happened to the logic of lending. The old question, can this borrower repay, was quietly replaced by a new question. Even if they can't repay, isn't the house itself worth more next year? If the borrower defaults, the bank forecloses and sells the house for a profit. Everyone wins, except what happens when prices stop rising? But we are not there yet, because in 2004, 2005, 2006, nobody believed prices would ever stop rising. They had data, charts, models, experts. They had Alan Greenspan, chairman of the Federal Reserve, standing at podiums telling the world that the American housing market was the picture of health. They had television programs dedicated entirely to house flipping. They had mortgage brokers opening offices faster than Starbucks. And they had something else. They had demand. They themselves had manufactured. On page 3 of the Black Book, we find a phrase so elegant, so perfectly designed to sound reasonable while being catastrophic that it deserves its own chapter. The Nina loan. No income, no job, no assets. You could walk into certain lenders in 2005 with nothing, no pay stub, no bank statement, no employment verification, and walk out with a $500,000 mortgage. They called them stated income loans. The borrower stated their income. The broker wrote it down. Nobody checked. And there were brokers, commissioned per loan signed, who were actively coaching borrowers on what numbers to write. Not enough income to qualify. Write more. Here's a number that should stop you cold. At the peak of the housing bubble, roughly 40% of all new mortgages in America were either subprime or Alt-A, which was the polite term for loans that were nearly as risky but came with slightly better paperwork. Nearly half of all new American mortgages were built on sand. And on top of that sand, the world's largest financial institutions had constructed a tower of derivatives and securities worth tens of trillions of dollars. Tens of trillions. Now the cracks begin. They always begin quietly. In 2006, something shifted, almost imperceptibly at first. Home prices in Miami, then Phoenix, then Las Vegas. They plateaued. Then they ticked down 1%, 2%. The brokers weren't worried. The banks weren't worried. The rating agencies were not worried. But in the back offices of a few hedge funds, some very quiet people were starting to ask questions. One of them was a man named Michael Burry, a one-eyed doctor turned fund manager who sat alone in an office in San Jose reading, line by line, the actual loan documents inside these mortgage-backed securities. What he found made him physically ill. The loans were worse than anyone publicly admitted. The teaser rates, the balloon payments, the adjustable rate mortgages designed to look affordable for 2 years and then reset to payments that no borrower could realistically sustain. Burry made a bet. He bet against the American housing market. His investors thought he had lost his mind. He had not lost his mind. He had simply done the reading. 2007, the adjustable rate mortgages began to reset. Across millions of households, monthly payments jumped, sometimes doubled. Families who had been making payments on a $1,500 monthly mortgage suddenly owed $3,000 they couldn't pay. Delinquencies rose, then defaults, then foreclosure notices began arriving in mailboxes across the country. The homes went back to the banks, and the banks tried to sell them. But now, everyone was trying to sell and nobody was buying. Prices didn't plateau. They fell. They fell hard. And when prices fell, the entire logic that had justified a decade of reckless lending, the idea that the house itself was the collateral, the backstop, the safety net, collapsed. AIG had collected billions in premiums while quietly amassing obligations that would have required, had everything gone wrong at once, more money than AIG had. More money than AIG could ever have. More money than existed in AIG's universe. But as long as the models said the probability of simultaneous collapse was near zero, they kept selling. Here is what the models missed. The mortgages inside the securities were not independent risks. They were all connected, all correlated, because they were all subject to the same underlying disease: falling house prices. The models assumed that if one homeowner in Cleveland defaulted, it had nothing to do with a homeowner in Phoenix defaulting. But they were both subprime. They were both on adjustable rates. They were both subject to the same national collapse of the same market. When one fell, they all fell at the same time. Together. By the autumn of 2007, Bear Stearns, one of Wall Street's most storied investment banks, reported that two of its hedge funds had collapsed almost entirely. The funds had been loaded with mortgage-backed securities. The losses were staggering, and the market began to understand, maybe for the first time, that this was not a contained problem. This was systemic. 2008, the year the mask came off. In March, Bear Stearns itself was rescued in a fire sale arranged by the Federal Reserve, sold to J.P. Morgan for $2 a share, a bank that weeks earlier had been valued at over $60 a share. The markets shook, but the government intervened. People told themselves the worst was over. It was not over. In September, Lehman Brothers filed for bankruptcy, 158 years old. The fourth largest investment bank in America, gone. What happened next was unlike anything the modern financial world had witnessed. The credit markets froze. Banks stopped lending to each other because no one knew what was in anyone else's portfolio. No one trusted the securities anymore. No one trusted the ratings. No one trusted the ratings. No one trusted the models. And when banks stop trusting each other, the entire economy stops. Businesses couldn't get short-term loans to make payroll. Municipalities couldn't finance basic operations. The machinery of commerce, which runs on credit the way an engine runs on oil, seized. The United States government, the bastion of free market capitalism, the nation built on the principle that businesses that fail deserve to fail, spent $700 billion bailing out the very institutions that had caused the collapse. Not the homeowners who lost their houses, not the workers who lost their jobs, the banks. And here is the betrayal that sits at the center of this story. The one that the history books will not let us forget. In 2009, as unemployment climbed above 10%, as families lived in cars, as tent cities appeared outside major American cities, Goldman Sachs paid out $16.9 billion in bonuses. $16.9 billion. The system had privatized the gains and socialized the losses. The bankers who engineered the catastrophe used taxpayer money to survive it and then paid themselves record bonuses from the other side. The final lesson of this page is not about mortgages. It is not even about Wall Street. It is about what happens when incentives are severed from consequences. When the person who takes the risk does not bear the loss, they will always take too much risk. When the people who rate the product are paid by the people selling the product, the rating means nothing. When the regulators are promised lucrative private sector jobs by the very firms they are meant to police, they will look the other way. The 2008 crisis was not a failure of intelligence. The rooms were full of brilliant people. It was a failure of accountability. And the most dangerous sentence in any financial system, in any boardroom, in any era, is this one. It won't happen to us. 8 million jobs, 6 million homes, $14 trillion, and not a single senior Wall Street executive went to prison. And with that, the Black Book closes. Subscribe, and we will open the next page soon.